In July of 2026, the largest bank in America put $24 million into welding classes, apprenticeships, and a new submarine factory in Philadelphia. On its own, that sounds like a modest local news story. Except JPMorgan doesn't do modest local news stories. This is a bank that just posted the most profitable quarter in its 150-year history, and it chose to spend part of that windfall betting on an industry the United States basically walked away from decades ago. Some people will tell you this is just good PR, a bank polishing its image next to defense contractors and senators. But look closer and a different story shows up, one about a bank that thinks it knows where the next 20 years of American industrial policy is heading, and wants to be standing in the right spot when it gets there. So why would the most profitable financial institution in the country bet real money on an industry that's been dying since the 1970s? Here's what we're going to figure out. Why did shipbuilding, an industry America basically gave up on, suddenly become something Wall Street wants a piece of? Who actually benefits when a bank finances a submarine factory instead of just, say, a tech startup? And what does JPMorgan know, or think it knows, that makes this look less like charity and more like a calculated position? Think of it like the tide. For 50 years, the tide went out on American shipbuilding, quietly, steadily, almost nobody noticed it happening. Now JPMorgan is betting the tide is turning back in. Keep that image in your head, because we're coming back to it more than once. Before we go further, you probably assume shipbuilding is a niche, almost irrelevant industry, something for history books about World War II, not something that matters to your portfolio or your job market. That assumption used to be reasonable. It isn't anymore. Ask yourself this: if a country can't build its own ships, can it actually defend its own coastline, resupply its own military, or move its own goods without depending on someone else's factories? That question sat quietly unanswered in Washington for decades. Now it's front and center. Let's rewind to see how bad the decline actually got. In the 1960s, the United States had a merchant fleet of nearly 3,000 ocean-going ships flying the American flag. Today that number has collapsed to fewer than 190. Meanwhile, more than 60 major shipyards that used to dot the American coastline have shrunk down to roughly 20 still operating. And the industry that replaced American shipbuilders wasn't a mystery, it was China. Chinese shipyards now build somewhere between half and 70% of the world's commercial ships in a given year, depending on which recent report you read, while America's share of that same global market has fallen to about 0.1%. According to the U.S. Navy's own estimates, China's shipbuilding capacity is now more than 200 times larger than what America can currently produce. Picture that as a football stadium of shipyards on one side, and a single high school gym on the other. That's roughly the gap we're talking about. Here's where it gets interesting, because America has actually solved this exact problem once before. During World War II, American shipyards built cargo vessels, Liberty ships, faster than German U-boats could sink them, eventually cranking out nearly 3 ships a day at peak production. That wasn't magic. It was a coordinated push of government money, private capital, and a workforce trained almost overnight to weld steel plates into hulls. The lesson buried in that history is simple: shipbuilding capacity isn't something you flip on with a policy memo. It takes years of training welders, electricians, and pipefitters before a shipyard can actually produce anything at scale. That's the bottleneck nobody talks about enough. Not steel, not shipyards, but people who know how to build ships. Fast forward to today, and that same bottleneck is exactly what's driving this JPMorgan investment. The bank's own research arm estimates the country will need something like 250,000 new skilled shipbuilding workers over the next decade just to rebuild what's been lost. Jamie Dimon himself has put a similar figure closer to 300,000, and pointed out these are jobs paying around 6 figures without requiring a college degree. That's not a small labor gap. That's closer in scale to hiring every single person currently employed by a mid-sized American city. When JPMorgan put $13 million into Rhodes Industries, a Philadelphia supplier that builds components for General Dynamics' submarine program, and added grants aimed at training welders and electricians, they weren't funding ships directly. They were funding the workforce pipeline that has to exist before any ship gets built at all. This didn't happen in a vacuum, and this is where the psychology gets interesting. Geopolitical fear is a powerful motivator for capital, maybe more powerful than opportunity alone. China's naval fleet has now grown to more warships than the U.S. Navy currently operates, even though the U.S. fleet still carries more total tonnage. Add rising tension over Taiwan, an ongoing war in Ukraine, and conflict in the Middle East, and you get governments everywhere suddenly treating "can we build our own stuff" as a national security question instead of an economic footnote. JPMorgan didn't invent this shift, it read it. Back in October of 2025, the bank had already launched something called the Security and Resiliency Initiative, a 10-year, $1.5 trillion commitment to industries it considers critical to American resilience, everything from semiconductors to critical minerals to, yes, shipbuilding. The Philadelphia investment isn't a standalone decision. It's one small piece deployed out of a much larger, already announced war chest. And here's the part that should make you pause if you're tempted to call this pure altruism. JPMorgan has explicitly said it does not expect lower returns on this money. This isn't a bank quietly eating losses to look patriotic. Loans get repaid with interest. Equity investments are expected to grow. The philanthropic slice, $6 million of the $24 million here, is a small, deliberate accessory to a much larger commercial bet, not the main event. When a bank with $4.6 trillion in assets moves money into an industry, it's rarely because the CEO had a moment of civic inspiration. It's because someone in that building ran the numbers and decided the government is about to spend enormous sums propping this sector up, whether through defense contracts, tax credits, or new legislation, and getting positioned early, before that spending really accelerates, tends to be good business. Think of it less like charity and more like buying real estate in a neighborhood right before the city announces a new subway stop. There's also a quieter signal buried in the timing. This announcement landed at a Defense and Innovation Summit in Pennsylvania, standing next to a sitting president and a U.S. senator, with cameras rolling. Capital allocation decisions rarely need a stage and a governor in the room. When they get one anyway, it's usually because the bank wants policymakers watching to remember who showed up early, a relationship that tends to pay dividends later, in the form of favorable financing deals, government contracts steered toward its clients, or a seat at the table when the next round of defense spending gets decided. So let's come back to the question we opened with. Why would the most profitable bank in America put money into an industry that's been shrinking since the Nixon administration? Not because shipbuilding is suddenly profitable on its own, it still requires new workers, new factories, and probably new tariffs or subsidies to make sense economically in the near term. JPMorgan is betting on the tide, not the current wave. It's betting that a decade of geopolitical pressure, competition with China, and political will in Washington is about to reverse 50 years of decline, and that whoever finances the people and factories now will be the first ones in line when that reversal actually pays off. Whether that bet is right depends on things no bank fully controls: congressional funding, global tensions easing or escalating, whether 250,000 Americans actually want to learn to weld. But JPMorgan isn't in the business of hoping. It's in the business of positioning ahead of a trend it's already convinced is coming. The tide went out on American shipbuilding for half a century, slow enough that almost nobody noticed until the gap became a crisis. Whether it's actually coming back in is still an open question. But the fact that the largest bank in the country just put real money on that answer being yes, that's worth paying attention to, whether you own JPMorgan stock, work anywhere near a shipyard, or just want to understand where the next wave of American industrial money is quietly heading before it becomes obvious to everyone else.